Hi, everyone. I am Lonnie Bloom, partner and co-lead of Withum's e-commerce sector. And today I'm joined by PitchBook's Eric Bellomo. Eric covers e-commerce, e-com enablement, and emerging tech out of PitchBook. So really excited. This is a favorite time of year. We're going to do a quick recap on 2025. We'll talk about what to expect in 2026. Eric, really happy to have you here. When you think about where capital is concentrated in 2025, there's certain categories that overperformed and some that underperformed. We looked at global VC and where they deployed their money, over 500 billion of capital in 2025. AI is driving about over 50% of that. So I'm curious your take on how e-commerce was impacted by how VC was distributing their funds.
Yeah, definitely. Well, first, thank you for the opportunity to be here. I was kind of laughing to myself before this call, and my official starting point of the holiday season is when I get the message to schedule this call each year. It's not Mariah Carey or the decorations. It's the schedule from Withum. So I kid, but thank you very much. Yeah, lots to unpack on the private market side, to say the least. So I'll start with maybe some aggregate observations, and then we can kind of drill down into what that means for consumer. But if you were to look across private markets, VC and PE, and just look at top line deal flow, you would think that 2025 was a pretty strong year. But I would also say that's just kind of scouting the box score, so to speak, and that the underlying story is actually one of concentration. So through Q3, I think the trend line is very clear, which is that we had the second highest annual total for deal value in VC again, specifically. But the top 10 deals accounted for about 40% of all dollars deployed into the startup ecosystem. By extension, the share of sub $5 million rounds, so small deals broadly defined, continued to decline quarter over quarter and year on year. We see a similar concentration theme playing out in public equities, right? So the Mag 7 account for a disproportionate share of S&P gains. On the funds side of the equation, we just saw Andreessen Horowitz close a $15 billion round, which was about 22, I believe, percent of all funds raised on the year as well. So there is some good news there, and there's some bad news for e-commerce enablement, consumer writ large. The bad news is that e-commerce doesn't really have a player at the quote unquote mega deal level, right? So there's no Waymo, Databricks, OpenAI, Anthropic. They're playing a bit of a different game here, meaning those who are fundraising and closing deals are exposed to the headwinds for weaker demand on small deals. The good news is that 1 degree removed, we have platforms like Perplexity and Vercel that are using commerce as a distribution lever or a wedge use case, so to speak. And then we have use cases like OpenAI and the Target or Instacart apps, Google and Walmart at NRF just this week. So the category is retaining mind share for investors, but it's extremely competitive. One layer deeper than that. So on my e-commerce enablement, so SaaS platforms, the data we publish there is roughly pacing for parity year over year on dollars raised, but a contraction on deals closed. So the volume of deals. On the retail and CPG side of the equation, it's tougher to put a positive spin on that. While PE as an asset class and the middle market generally recovered in 2025, consumer contracted by basically all measures. About 46% lower year on year for deal count, about 23% lower for deal value. Another way to slice those numbers are in 2024, 9% of all PE deals went to consumer companies. That was 3% in 2025. This concentration narrative, this intense competition is, very much impacting the consumer ecosystem, and we're competing really with some of the fastest growing technology companies of all time. It's a bit nuanced there for sure.
Yeah, it's super interesting to see the impact of Mag 7 AI and everyone's kind of race towards being the best AI company out there, right? And its impact on the global economy, because it's kind of masking some of the challenges that the consumers facing. Right? You look at the numbers, like you said, the numbers look good, but you start to peel back the layers there, and you keep hearing from clients and companies out there that it's a tough year for consumer. Certain industries are winners, certain are not, but we faced inflationary pressures and tighter wallets in 2025. consumer spend is down. How did that change what companies did for their customers? What did customers expect in terms of value and personalizations? And what tough challenges did these companies make to sort of retain relevance and stay on their growth mindset, profitability, et cetera?
So you'll already kind of pick up on a through line out of the gate here, which is that top line is one thing, concentration and competition kind of one layer below that. So one narrative that I find interesting here is that the wheels of commerce keep turning, right? So the following data is from JP Morgan, but I think it's telling. In Q3, 60% of S&P 500 companies raised earning guidance on the quarter, and that compared to 29% in Q1 and an average of 46% since 2007. So, of course, that's not all just retail, but directionally, that's pretty good news. Among other things, that was supported in particular by margin expansion in consumer discretionary names. Elsewhere, kind of in the aggregate outlook, right, we have inflation that's higher than we'd like, but relatively steady. Same thing on unemployment. It's higher than we'd like it to be, but it's stabilized a little bit post shutdown. We're seeing productivity gains in the market. And so the consumer segment, broadly defined, is a huge portion of that. But when we, again, go one level down, to your point on some of these kind of levers that brands are pulling, I think really value is the name of the game. One of the truisms I see across retail, investing broadly, higher education, kind of these cross domain takeaways, is that it is a bad time to be in the middle. There is a clear flight to each side of the bell curve distribution, right? You are either Walmart or your Tiffany's is kind of the trope you'll find here. And I think this plays into the underlying theme of economic bifurcation, right? And concentration. We are more, the economy being we, are more reliant on high income households, but another way to phrase that would be asset holders, equity owners, homeowners are experiencing different economic reality than everybody else. So when the holiday season rolls around, right, we see that cohort spend comfortably. The total spending figures for Q4 were pretty darn strong. And categories like electronics or furniture, for example, did pretty well. But everybody else was pretty willing to wait, to delay a purchase, to use a buy now, pay later platform, to stack discounts, and so forth. And one of the interesting data points and kind of all the post-holiday reporting that I saw was from Klaviyo, which pointed out that although discounts did, as expected, peak on Black Friday and the days that followed, we didn't have the high spikes of promotion as we have in years past. So this again kind of introduces that tension around, consumers are waiting, they may or may not get the discount, we're seeking value, we're turning to financing options, etc. And it creates a complicated picture for merchants. And as far as some of the value creation levers we're seeing pulled, there really isn't, unfortunately, a one size fits all, right? We're seeing the big guys, Amazon, Walmart, absorb price increases. We're seeing some players like IKEA raise prices throughout the year. Others cut prices in a bid to maintain some loyalty. And then another category would be like highly discretionary names like Funko Pop or Under Armour, which just really struggled throughout the year. So yes, personalization, value orientation pricing, community build, these are all relevant levers, but there's a lot of operational complexity kind of one cut beneath the surface. And again, top line numbers look good, but it's intensely competitive in most of these categories, right?
Right. Yeah, it's an interesting take. We see a lot of clients just having margin pressures and having to make the decision, do we raise prices and pass to the consumer? Do we absorb? We've seen buy now, pay later. That's a big trend with consumers, and bundling sort of those higher margin products with the lower SKUs just to get things out the door, bring more value to customers. And definitely we see a push for value personalization. That's a need for the consumer. It's certainly interesting with the funding market being where it is. But yeah, we've seen certain brands and channels be outliers. We've seen a lot of sustainability and health brands sort of come out on top and get new funding and are growing. Think like hydration mixes, supplements, fitness gear, etc. Are you seeing the same? Is that sort of a trend? And do you think it's a trend to stay?
Shortest answer of the conversation, yes. Yeah, absolutely. I think it is one of the bright spots in all of my coverage areas. So a few, I think, interesting deals that kind of point to this trend. Elf Beauty buys Ron for $1 billion without any wholesale distribution play. Pepsi buys Poppy, I think it was 1.7 billion. We see Grunz reach a $500 million valuation in less than 2 years. We see David Protein hit 730 million in 1 year. And none of those plays are desperation, negative margin investments, right? These are bets on kind of a new class of consumer company post direct to consumer wreckage, to be a little dramatic, but also on new consumer habits. So one phrase I like from an investor that I follow in the space, I'd recommend everybody follow along as well. Brian Sugar from Sugar Capital puts forward the phrase habitual consumables, which is frequent use products, frequent reorder products, often utility offerings that are kind of wrapped in a lifestyle and wellness branding. So these are things like acne patches, prebiotics, hydration mixes, lip treatments, etc. And yes, I think there's a couple things to pull apart there. There is what I would say kind of almost a new breed of founder and operator, which has, again, post direct to consumer scrutiny on them, a greater focus on CAC, LTV, a little more nuanced metrics like, net revenue retention from a cross sell, again, bundled to your point. But it's more than that. I think there are some interesting tailwinds that are intersecting here. So social media feels saturated, but it's as prominent in community building as ever. Supply chain barriers to entry are lowering. There's a degree of retail consolidation that creates an opening and a need for some of these fresher brands. And consumers are more intentional about wellness routines post COVID, but also as there's more information available. So I remember a time before the Huberman Lab and Peter Attia, and this just dispersion of information that's more digestible than a textbook. I do think there's also kind of like a capital A autonomy trend here as well. So you look at the function healths of the world, wearables like Aura and Whoop paired with healthcare costs that are effectively unsustainable. You see pushback against big food. So where I am in San Francisco, the city just brought a lawsuit against some of these big food companies, healthier products and whatnot. We see GLP-1s being more commonly embraced, more frequently embraced. So again, that was the long answer. The short answer is absolutely. I do think this is one of the more durable trends, and it intersects with technology, but also structural healthcare costs and information availability in all of these things. So I think it'll be a pretty relatively strong year compared to other categories in the kind of broader wellness space.
Yeah, I think just in general, and I've seen highlights that current set of consumers are less or more focused on health. And now there's a lot of non-alcoholic beverages, kind of new brands coming out, and I think it's a trend to stay. I think a lot of people focus on health, and we'll see some positive results out of that. And
there was a time not long ago, like a year ago, where we couldn't even get non-alcoholic beer. I was training for a triathlon, and I think the athletic beers were unavailable, and then now they're everywhere. But there's a time where they were so popular we couldn't get them. The Ironman franchise actually just had their strongest year for competition, the number of events and participants. It's
right.
It's having a moment for sure.
Yeah, it's great. Yeah, triathlon and beer probably don't mix.
No, not if you want to do well.
Yeah, right. So yeah, thinking of our clients, and they're selling on Amazon, D2C, TikTok shops now is big. Which sort of channels sort of surprised you in 25? Who is playing offense amid tariffs and pricing pressures and things like that, and returns pressures?
Yeah. So again, I'll kind of maybe start at a high level and then get a little more specific. But the way this conversation, or this topic, I should say, typically comes to me is in kind of the following. This, I think, is the era of distribution focus, distribution innovation, as we reach a saturation point with content and choice. So, for example, we see AI companies launching directly on Discord before going to the App Store. We see consumer companies testing the waters on Roblox or Fortnite to get to a younger consumer. As we talked about earlier, Ron didn't have any wholesale distribution at the time of acquisition. On the retailer side, Walmart, Target, I think there's pretty clear realization that the core customer is maybe aging a little bit, and the late 20, early 30 something who's buying a premium gummy is going to buy diapers and electronics for 20, 30 years as well. Going back to the the creator comment earlier, I think it's easy to kind of see the Mr. Beasts of the world and think that the creator era is saturated and done and whatnot. But the My Sephora storefront leans further into creators, tries to box out the middleman there a little bit as well. And we're seeing their influence pop up in other points of the sales calendar as well, like back to school shopping had a big year as well. So all that being said, yes, Shopify remains prominent. They've taken a bit of, for example, a partnership approach with Perplexity. We've seen also some walled gardens emerging. So Amazon blocking bot traffic and leaning into their own Rufus offering. We've also seen a quote unquote like frenemy approach from Amazon. So supporting fulfillment from Walmart, Shopify, Shein in years past and expanding in 2025 to include Etsy, Temu, TikTok Shop as well. TikTok has had a turbulent year, factoring in and putting aside the ban and sale and all of these things. The app has struggled to also stay in the top 10 most popular consumer apps over the last quarter at least, but probably going back another month or two. So I think the reality for brands is, again, a complicated one. Distribution is a key play right now. And on the other hand, there's as many channels to consider. So it requires a pretty nuanced perspective on the ideal consumer and where they're spending their time.
Right. Yeah, we see it from a finance, accounting, and just management operations perspective. The omni-channel approach, it's becoming more and more complex and nuanced. If you're selling Amazon versus D2C versus TikTok shops, there could be some downstream impact that you might need leaders and managers managing each one of those channels and building out teams around it to manage the sort of operational impact. If you're just selling on one channel, you're leaving money on the table, right? So there's D2C for loyalty, social commerce for discovery, and marketplaces like Amazon for scale. That's kind of the playbook we've seen a lot of our clients do.
Yeah.
So yeah, I want to, Eric, kind of go into 2026. What are the trends? What we're kind of going to expect from the new year? We think about a few different trends and technologies: AR, augmented reality, VR, virtual reality, and its impact on our e-com clients and brands. We're seeing retailers using immersive tech report 25% fewer returns, 20% higher conversion rates. Are those types of shopping experiences becoming necessary for certain brands, and kind of how do they measure like returns avoided, right, as a KPI?
So you can pencil me in as a little skeptical on this category. So actually, I did a webinar on AR, VR, XR in Q3. That was in a health perspective, but I think I still think at scale it's a little bit of a solution looking for a problem. I will say the subsegment that I'm tracking in my e-commerce map had an okay year. I think the kind of bump, so to speak, or the tailwind there a little bit has been the just improvements in multimodal LLM asset generation, 3D assets that can become a little more realistic on a website. From a venture perspective, we haven't really seen a breakout platform exit and justify some of these valuations. Again, the form factors changing a little bit with the glasses from Meta, Ray-Ban, Oakley, and the like. I do think the upshot here is whatever the end state ends up being. A head-mounted device, glasses, just native first-party experiences within a website. The upshot is we're gonna purchase there. It will be an opportunity to transact. I think otherwise, we're kind of seeing it as a nice to have or a tacked on experience. I think it's easy to imagine the experience where you fire up ChatGPT, you take a picture of your room, it'll search for a couch that fits in there and you can easily buy it. Like those sorts of things seem pretty feasible. I wouldn't necessarily say, in my conversations at least, that it cracks the top 5, 8, maybe even 10 operational challenges right now in this operationally complicated environment. When we're ruthlessly prioritizing for the year, I don't hear AR and VR often making the cut. As it pertains to returns, that is the industry's albatross, right? So anything that can deflect that volume of returns is positive. But I think the returns problem is a much more complicated one. It involves internal ownership and third-party logistics platforms and the incentives around conversion of customers. Like it's pretty complicated. So I don't know that the tracking there has necessarily been totally smoothed out either. Reality Labs is incinerating cash as it has been. It's going to kind of remain in the zeitgeist, so to speak. But I don't think it's moving the needle for many players right now. So yeah, a little skeptical, I guess.
I would agree. It's like it's certainly nice to have. It's a new experience to shop, but consumers like their traditional e-commerce. Some of them are going to stores still and trying to avoid the new tech. I think it's a nice to have, and if you do a cost benefit, it makes sense. You go with it.
Yeah. And I bought these glasses using a virtual try on. So it's not a zero, right? But I think again, this in this theme of kind of ruthless prioritization in the coming year, I think it can be a tough sell.
Right, right. It's kind of shifting gears towards tariffs, profitability, de minimis rules kind of changed. There's new duties kind of shaping just cross border economics. How should e-commerce operators rethink their fulfillment footprint and pricing strategy? Are you seeing companies sort of accelerate nearshoring coming to the U.S. or are they passing on costs to customers? What does that mean for margins going into 26?
Gosh, I mean, what a year it's been on that front. Again, I think there's a few ways to slice this one. I will say from a kind of venture and e-commerce tech standpoint, like my vantage point is maybe a little bit more at the macro, but I think it's still worth thinking through. So right now, we still see businesses absorbing most of the tariff costs, and some of your listeners and readers probably came across the report from Goldman Sachs that basically said they expect 200 basis points of cost burden to be passed to consumers by around the end of 2025, maybe the end of Q1 26, which would amount to about two-thirds of the 3 to 4% increase in the CPI in 2025. We'll see how that ultimately shakes out. I think I include myself in the following: the impact that we expected at the beginning of the year and then what it all looked like at the end of the year were pretty far apart. It was not as bad as I think, again, many on the podcast circuit, and even you can pull up my own research. I was skeptical. I think the bottom line there is the import share of U.S. consumption is, depending upon how you slice the numbers, about 10-11%. That's also JP Morgan number. The vast majority of our consumption is service based, which is only 6% import based. On the nearshoring, I think is to be expected in the long term, but hard to account for in the near term. I think the thrust there is beyond just e-commerce, right? We see geopolitically like blocks emerging. I think it's natural to assume we'll see more intra-block trading moving forward. That's expensive, that's time consuming, and we just got through the holiday season. This is an evolving landscape. It can be difficult to assess the value of brands, their margins, and determining their staying power, profitability amid this kind of price distortion, income erosion, even if it hasn't been as bad as we expected. A willingness to substitute products in search of value, like we were talking about earlier. That's kind of the downside of the complexity side of the equation. And I think downstream for some of my e-commerce tech coverage, we are seeing a couple of camps emerge. We're seeing the do more with less, lean into Claude Code and just get by with what we can camp. And then we've got the other camp, which is like, there's too much complexity going on. We're going to stop all non-essential buying process on the tech vendor side. Like, we're going to pause anything that's not a top tier priority. So lots of dials to calibrate. I do think it depends a little bit upon the brand, their size, their end client, and whatnot, but it's been extremely complicated for sure.
Yeah, I would say the silver lining with tariffs is that it kind of forced, brands to take a peek under the hood, adjust their pricing strategies, and not just holistically, just at a SKU level, like going very granular and allowing companies to adjust their P&Ls as a result and become more profitable. Silver lining with everything. I do want to talk about AI. I think it's, certainly changing the world. It's going to play a crucial role in just enhancing online shopping experiences, analyzing data for companies and customer data, providing personalization, personal recommendations, improving conversion rates. Businesses are currently leveraging AI and creating tailored shopping experiences. I want to think about how this is going to impact marketing, how it's going to impact operations, consumer experience. So from a marketing perspective, you see brands saying, going and creating whole branding strategies using AI. Are you kind of seeing that with creative generation, targeting, attribution?
Yes, again, is the short answer. I think number one, the discoverability layer is actively shifting, right? So granted, it was a small start, a relatively lower starting point last year, but about an 8x increase in bot referral traffic around the holidays. That's an Adobe number. We saw shoppers using AI assistants converting about 40% more frequently than everybody else. I think the trajectory there is SEO was relevant when people searched. Social is and was relevant when people scroll. And now we're kind of in this conversational era. So on the venture side, again, I'm seeing AI deals full stack, everything from data and analytics, CDP type platforms, all the way to fashion native vertical specific platforms. The other end would be something like content creation, which to your point, I think should be presumed to going to zero effectively, right? The fidelity of some of these models are improving at staggering rates week over week. Sometimes business, right? Cost is going to zero. Code generation is getting incredible. And then, on the incumbent side, the Mag 7, the big players here are really throwing their weight around. So we've seen the cross pollination here a little bit. Amazon's backing everybody, Nvidia's backing everybody, Meta's using AI to improve their attribution in their ad tech platforms. I think we'll see ads. That's one of my predictions, not to spoil it, but we'll see ads in platforms like ChatGPT in the coming year to boost some of this monetization. So I do think there's a little bit of complexity there in some of the big platforms are also building competing features here as well. I think the attribution side is perhaps more complicated as a result of adding touch points to the mix. It was already pretty broken beforehand, right? So you have a browser extension that hijacks the attribution. You have cross-device shopping that's going to break your tracking. You have cookie deprecation. And now we're adding, again, more touch points with AI. And the agentic shopping label kind of gets distorted when we talk about agent assisted versus agent autonomy. So again, in that domain, I actually think it could complicate things a little bit. I won't give away my other, agent-related prediction. So it's here to stay, and I think a lot of our internal operations are going to change. I also think, at the risk of rambling a little bit here, as a former product manager, I can tell you that rewiring consumer behavior is a very hard thing to do. So old habits die hard as well.
Yeah, it's interesting. I think the attribution part is interesting. Just for listeners, attribution in marketing e-commerce refers to we figure out which touch points or channels influence the customer's decision to buy, and then assigning credit to it. Right? Was it an agentic shopping experience? Was it TikTok? Was it an ad you saw on Facebook, or was it the website? There's so much data behind the scenes that's involved in that. So the way that when it's huge, massive data sets that take a lot of manual manipulation, that's where AI plays a huge role, right? It's going to be able to sift through that data in seconds and give you, an output that you could use and make management decisions. So I think that's going to be an interesting to see how and if it impacts P&Ls and financials when it comes to reporting. But yeah, it's certainly changing the marketing strategies for our clients.
Yeah, absolutely.
So from an operational perspective, beyond the front end hype where AI is kind of quietly moving the needle, whether through smarter inventory planning, dynamic pricing, or agentic payment protocols, which sort of operational use cases are really proving ROI today?
What can really move the needle right now is the less than glamorous use cases, right? So it's empowering the non-data analyst to query a data set in natural language and either not have to wait for a data team member to do that work or to more quickly have an insight around a customer cohort. That's material. As a former product manager, the backlog is never ending. So as much as we talk about, hiring more people, less people, I can tell you there's a lot of work in the backlog for the developer to do. And being able to work a little bit faster with a code completion tool, whether or not it's e-commerce specific, is meaningful. And I know that there's a little bit of a trope, or it's gotten trite, I should say, at this point to roll out the 2 weeks to 2 days. But again, not to be on my soapbox here, but I can tell you I spent a lot of time going back and forth with designers and different internal team members before I could even write a ticket for a developer. And the ability as a PM, for example, to be able to pump a spec into Replit or V0 or Figma even and have a working prototype is a meaningful time savings. And again, this is against a backdrop of huge operational complexity, platform wars, tariff wars, not to over dramatize the landscape, but yes, all of the things we're talking about here, right? Inventory forecasting, payment protocols, dynamic pricing, all of that is relevant. But the here and the now needle moving things are having more effective tools available to more people to do their day-to-day work.
Yeah, the less glamorous use cases are the ones proving the higher ROI today. I'm really curious to see how it kind of changes the landscape going into the future here. But think about the consumer, the experience and engagement, and AI and its sort of impact on the consumer's experience. We're hearing about a lot about AI-driven personalization and conversational commerce. How far have brands really gone in delivering, a truly personalized experience?
Yeah. So for the sake of a lively discussion, I'll throw out a potentially controversial take, which is like, let me not mince words out of the gate here, right? Like, yes, this is going to change a lot about how people shop and where they buy and who the big players are. It is a meaningful shift in the trajectory of technology. That said, I'm prepared to take the unders here. I'm putting aside the complexity around, again, agent assisted versus totally autonomous like we've seen some very big estimates from, I think with Morgan Stanley and a few other big banks estimating the impact of agentic commerce. And my bias here is it's hard to get people to change their behavior. The tolerance for errors, it can be relatively low, and I will sometimes gravitate towards a somewhat utilitarian perspective, right? Like, how much time am I saving, and how clearly can you present that to me, or how much am I saving right here, right now, and is it as frictionless as the experience I've gotten used to, which has been hammered out by 2 decades of Black Fridays, right? So, for the sake of debate for your listeners, I'll take the under. I think it will happen. It'll be meaningful, but I think it might be a little bit. It'll take some time to evolve here, and I think that kind of plays into another outlook I have, which is I think a lot of the investment and traction in the coming year is going to be on the infrastructure side, the things that lay the foundation and the piping, the plumbing for frictionless in the coming years. So when the next holiday season rolls around, we can debate how wrong or right that was, but again, optimistic in the long term. I think it's going to be tricky in some ways in the short.
Yeah, there's definitely an infrastructure hurdle to get by. I'll take the opposing, somewhat opposing, right? I think from an agentic shopping experience, by the end of 2026, autonomous AI shopping agents will become mainstream or somewhat mainstream, embedded in your phones, your tablets, etc. So if I would guess, by the end of 26, 5 to 10% of all consumer sales and transactions are going to happen through autonomous AI agents, and it's going to be just on your phone, and you're going to be ease of use. I get the changing consumers' behavior. That is going to be a hurdle. I think that's probably the biggest challenge, to your point. Once you have a sort of that unlock and experience it one time, if they get it right, there's going to be a lot of upside there, and the battleground that then shifts from winning consumer attention to sort of winning that agent's algorithm, figuring out what's right for you. And now you have a personal shopper at your fingertips. But yeah, what is your next bold prediction?
Yeah. So I front run my kind of big prediction, which is like I'll take the under for the sake of debate, and we can that'll be easy to call me out on it in a coming year. Elsewhere on the kind of, again, general infrastructure front, I think ads will be prominent. So I think there's a couple of VC backed ad tech platforms targeting commerce that raised Series A's this year. So I'll be keeping an eye out for some Series B's there as a kind of proxy for commercial value generated. Inclined to say we might see some ads from ChatGPT, potentially, OpenAI, maybe Anthropic post IPO, if that happens, in a bid to kind of, again, just keep monetizing that base, although their enterprise bent, maybe lowers that probability a little bit. We just saw Google start to roll out some basic ad units for their Buy For Me platform. We'll see, again, also how that impacts the Walmart alliance, which has an enormous retail media network. And then I think we're also going to see some consolidation or some shakeout around the protocols. So we've seen several rolled out from big players. But again, kind of going back to my PM hat a little bit, most shops don't have necessarily the bandwidth to test 2, 3, 4 protocols and then pick one, right? Like, speed is a little bit of the essence here because time is money, and speeding up this integration effectively at that is material. So I think we're going to need to see some lower technical barrier to entry there. So consolidation on that front. And then one prediction I tend to make each year, so maybe this will be the year and we can backlink to it in a few months. But I still think there's going to be some breakout brand that reaches a 9-figure valuation by distributing primarily through UGC ecosystems. And it's easy to forget that we did have a Roblox Shopify announcement earlier in the year, just got buried by everything else. There's a whole generation of young consumers with a staggering amount of purchasing power, given their relative age on these platforms. that's going to happen eventually. I'm going to keep saying it. This isn't the first time I've made that prediction. So.
Love it. Yeah, really excited. We'll definitely check back in a year from today and check in on those predictions, and then we'll be talking about 2027 and beyond. So, Eric, this has been great. Really appreciate the time. And if any questions on e-commerce, feel free to reach out to myself or Eric, and we're happy to chat.
Yeah, privilege is mine. Thank you for the opportunity to be here. So yes, please reach out with any questions afterwards.
Awesome. Thanks, Eric.